What do the Chinese renminbi, the Indian rupee, the Thai baht, the rand, the kwacha, the lira, the naira, and the Egyptian pound all have in common? Well, they are currencies of emerging markets that are battling multiple headwinds. Will they sustain a currency war, or is Argentina's peso collapse a bigger threat? To help us flip a coin to find out is Andre Cilliers, who is a director at TreasuryONE. And via Skype from Switzerland is Samy Chaar, who is the chief economist from Bank Lombard Odier. Gentlemen, thanks so much for your time. Are you, gentlemen, calling this a currency war, as in has this trade war between the US and China morphed into a currency war? Or the big moves that we have seen in emerging market currencies, in fact, major currencies so far, have these been a function of the global uncertainties? Samy, let's begin with you.
Yes, I think it's the two sides of the same coin, and basically the currency move that we've seen are a direct escalation from, especially on the Chinese side, from the tariffs. And the current fall of the renminbi basically totally offsets the tariffs that have been imposed so far. And we would imagine that if tariffs has to be increased again on the US side, the Chinese currency will have to fall a little bit more. So it's, again, a direct consequence of the global uncertainty that comes from the trade dispute. And obviously, the pressure can only continue unless they find a resolution to the conflict, which doesn't seem to be something that we can expect in the short run.
Certainly, because, I mean, Andre, what we did see when we saw the yuan fall below that 7 to the dollar level a few weeks ago was we saw interest rate cuts coming out of countries like India, Thailand, and New Zealand. For some, this is a signal that these countries are preparing themselves for the possibility of a currency war by making their currencies in a position to be more competitive. For others, it's a continuation of a trend that we have been seeing in which major global central banks are cutting rates. How do you see this?
I would not really say that it's got so much to do with a direct currency war. As other speaker mentions, it's global growth concerns that spurs this more than a direct currency war. And the more people are putting uncertainty out there as to what will happen between this trade war between the US and China, the more people get concerned, the less they spend, the more prices are driven down, the lower inflation becomes, and the more central banks need to actually adjust interest rates to try and get growth and inflation back into the economies. However, the more that they do that, the more uncertainty they add, and it becomes almost a self-fulfilling prophecy that we put so much fear into investors and into consumers as such that they do not spend and keep on driving interest rates lower. On the other hand, we have Mr. Donald Trump that wants his currency weaker because that would boost his export market and that would make some of his manufacturers more competitive. However, in the escalation of all of this, more and more people are being driven to safe haven assets, and everybody wants to buy something that's safe, that would be, in uncertain times, give them something to touch and to take. Hence, they still invest in the dollar. They still take their money out of the emerging markets. And they even flock to commodities like gold, and we've seen the gold price increase significantly. And that keeps on driving the dollar stronger and emerging markets weaker because of the withdrawal of money out of emerging markets.
And that's exactly what we have been seeing, Andre. I mean, the example that or the picture that you've just painted is exactly what has been playing out. And I'm interested in the strategy that you gentlemen are following. You know, they say that, you know, when the two elephants fight, it's the ants that get trampled down. And in this case, it is emerging markets. So, Samy, for you, are you adopting the follow the herd mentality where you are pulling out your funds from emerging markets, putting them into safer havens like gold and even the Japanese yen? Or are you doing things differently?
Well, what we try to do at this stage is to avoid big bets. Now, obviously, we have a big growth uncertainty because of the trade landscape, but we also have a very low cost of capital thanks to basically the central bank response. So it's trying to find a balance in portfolios between those two forces. Growth uncertainty, but cheap cost of capital. So what we try to do is to favor carry strategies over purely directional strategies in equities. We are indeed a bit defensive in emerging markets, but we're not totally out of these. What we would do in emerging markets is eventually to favor hard currency credit over typically equities. So we are still in it, but relatively we would favor debt and the defensive side of debt rather than the equity side. On a general portfolio level, we're slightly defensive, but not overly, again, because we have a central bank response. And if this moves forward, we'll probably get some form of fiscal response at some point, but it probably needs to deteriorate further. So keeping the bets low and trying to be as balanced as possible in portfolios.
Andre, I mean, given your huge exposure to emerging markets, living in emerging markets, are you betting on the dollar more strongly at this stage, or are you doing something differently?
If I look at people within South Africa, you know, in the property market, they say that there's three important factors, and it's location, location, location. In terms of the uncertainty that we live in today within the world, I'd say there's three important things when it comes to investing your money and managing your portfolio, and that's risk management, risk management, and risk management. So you have to diversify. You cannot take all your money out of the country because you live in this country, you live in one of the emerging markets, so you have to have some of your assets and some of your investments in that country, and you especially need to be liquid in that because you need to pay your bills, you need to pay your grocery bills, etc. But as for the rest of your funds, I would recommend that people take some of their funds outside the country and put it into safe havens, safe haven assets, hard currency, where they are spreading their risk and getting some diversity within their portfolios. I would just really, really caution that that should be the emphasis of your decision. Your emphasis should not be purely based on, yes, the currency will depreciate and hence I have to get my money out of the country. Because just as quickly as it's appreciated or depreciated, it can also appreciate, and then you will find yourself in the hot water. So risk management, risk management, risk management, and get some diversity in portfolios.
Right, got it. I mean, in terms of risk management, how are you guys managing against the risk of the collapse in the Argentina peso? We have seen that currency really, take a big hit as a result of the political uncertainty there. Not so much of a fallout in emerging market or in the rest of the emerging market complex like we did see when, for instance, the Turkish lira fell on its knees. Samy, your risk management strategy against the Argentine peso and your view on the impact that this could have for the rest of the EM complex.
In our view, the Argentinian crisis is more of a specific crisis, idiosyncratic crisis for and responding to the local imbalances. I would say, globally speaking, again, what makes our positioning in our portfolio is the broad global trade war, which is really a global risk. As for Argentina, it's more specific. The country is very challenged. It has a big political event in October, and obviously it draws a lot of anxiety for investors. And this is why basically we favor within the emerging space an exposure to hard currency credit rather than, for example, exposure to local or to sovereign debt in local. So I would say this is a risk we're not exposed to, and at this stage it is a risk for which we want to remain pretty distant to. So I would say it's specific, but it is not an opportunity as of now.
And Andre, for you, the Argentine crisis, are you exposed at all to it? And if so, how are you reducing that exposure possibly?
Well, Argentina is not one of our major trading counterparts. We do have trade with them, so there is exposure in terms of foreign exchange risk etc., for both importers and exporters. But as I said, not one of our major trading counterparts, so less of an impact on our side. And very more specifically to us as a company, we have very few people that is exposed to Argentinian risk. So for us, it's more a case of how the risk in Argentina and the impact of Argentina, the impact of them on other emerging markets, and protecting our customers against any risk that they might be exposed to in those areas.
Well, gentlemen, let us leave it there. Thank you so much for your time, of course, for telling us which strategies we should be adopting in this environment of a currency war.